Something big is shifting beneath Arizona's housing market right now, and almost no one is ready for it. Buyers who thought prices would keep climbing are suddenly hesitating. Sellers who expected bidding wars are quietly cutting prices. And what happens in the next few months will decide who gains and who loses in 2026. In just the past few weeks, mortgage rates have refused to follow the Federal Reserve's playbook, confusing everyone who thought they understood this market. The real driver isn't Washington. It's the bond market, inflation pressure, and investor fear pushing rates in directions no analyst fully predicted. Here's what you'll discover in this video. Why Arizona's housing momentum is slowing down, how mortgage volatility could flip the balance of power between buyers and sellers, and what data shows will likely unfold before the end of the year. Most people still believe the market will move in a straight line, steady, predictable, and safe. But the truth, as you'll see today, is that the forces underneath it are anything but stable. This isn't a replay of the pandemic boom or the 2022 cool down. This is a completely new pattern, one that could reshape Arizona real estate from Phoenix to Scottsdale heading into 2026. Everything you're about to hear is backed by data from credible real estate analysts and financial reports published in the last 7 hours. And by the end of this video, you'll understand not just where prices might go, but why it's happening, and what that means for anyone buying, selling, or investing in Arizona homes right now. Arizona stands in that strange quiet before a storm. Streets look normal, homes glow softly under the desert dusk, and from the outside it all feels steady. But underneath, pressure is building. The real estate market here isn't crashing or soaring. It's balancing on a knife's edge, between cautious buyers counting every dollar and confident sellers betting that prices will keep climbing. That balance can't last forever. Every boom in American housing history has one defining moment, a calm stretch that seems harmless until suddenly something snaps. And right now, in late 2025, Arizona is living through that calm. The numbers don't lie, but they also don't speak loudly. Not yet. Mortgage rates have stopped rising, but they haven't exactly fallen either. They sit like a pendulum, swinging just enough to make everyone nervous. Buyers wait for a break. Sellers hope for a rush. Both sides know one small change, a shift in rates, a flicker in supply, a tremor in confidence, could change everything. What's happening in Arizona isn't just about homes. It's about psychology. When people stop feeling sure about tomorrow, they stop bidding high today. Economists call it expectational cooling. It's subtle but powerful. You can't see it in listings or hear it in open houses. It shows up in hesitation, in the way buyers ask for one more day to think. But sellers sense it too. Some start offering small incentives. A free home warranty here, a closing cost credit there. Others double down, convinced the slowdown is temporary. The result is a strange duality. Optimism and doubt walking hand in hand through every neighborhood. In downtown Phoenix, luxury condos that once sold in days now sit for weeks. Out in Chandler or Mesa, first-time buyers stretch their budgets just to stay competitive. And in Scottsdale, the top-end market plays by its own rules. Insulated, confident, and still driven by cash. It's not a collapse. It's not a frenzy. It's an uneasy truce between demand and supply. Mortgage rates have become the invisible referee in this tug-of-war. Many assume the Federal Reserve dictates them, but the truth runs deeper. When the Fed cut its base rate in September of 2024, mortgage rates should have dropped, but they didn't. Instead, they spiked. It was a lesson in economic complexity. Mortgage rates are tied to far more than the Fed. They respond to 10-year Treasury yields, global bond markets, inflation expectations, credit spreads, even lender margins. Every tick upward or downward tells a story about fear, hope, and risk, not just policy. By mid-2025, rates had fallen below their previous year's highs, yet they crept up again by 1/4 percentage point. A reminder that volatility rules this era. Buyers feel it every time they check the day's rates. Lenders feel it when they try to forecast next quarter's demand. And so the question becomes, where do these rates settle next? If they drift down toward 5.5% or 6%, the market could reawaken. Pent-up buyers, especially those locked out in the pandemic years, could surge back, igniting bidding wars in mid-range neighborhoods. But if rates hover near 6.5 or bounce back above 7, confidence could fracture. This is why economists in Arizona call Q4 of 2025 the testing ground. It's the quarter that decides the tone for 2026. Right now, indicators are mixed. The Cromford Supply Index, which measures available homes, shows hints of bottoming out, meaning supply might rise soon. That's both good and bad news. More supply eases scarcity, but it also gives buyers more options, forcing sellers to compete harder. In economic terms, Arizona is in a state of price elasticity tension. Every extra listing dilutes pricing power. Every mortgage rate drop reignites demand. The forces are balanced. Barely. For sellers, this environment demands precision. Gone are the days when an average house could command a premium just by existing. Now buyers inspect every flaw, compare every square foot, and negotiate every detail. Sellers who list early in the fourth quarter, from October through mid-November, may still capture eager buyers rushing to close before the year ends. But by December, the energy fades. Foot traffic slows. Offers thin out. It's not panic, it's exhaustion. After years of turbulence, everyone is tired of guessing what happens next. Some sellers turn strategic, offering flexible closing dates, paying for appraisal gaps, or even buying down interest rates for their buyers. Others refuse, confident their neighborhood will stay immune. And for a few segments, especially high-end communities with limited supply, that confidence might still be justified. But across most of Arizona, the balance of power is quietly shifting. For buyers, the mood is different. For the first time in years, they feel leverage returning, days on market are stretching, and negotiations no longer feel like auctions. Buyers can finally breathe, but only slightly. They're watching rates daily, waiting for a window to lock in something affordable before volatility strikes again. And here lies the irony. The same uncertainty that slows the market also keeps it alive. When everyone expects a crash, they act cautiously, and that caution prevents the crash from accelerating. It's an economic paradox, a dance between fear and restraint. To understand this balance, we have to look at psychology again, not just numbers. Housing markets aren't purely financial, they're emotional systems disguised as economic engines. Each transaction is fueled by hope, fear, and perception. When people feel safe, they spend. When they doubt stability, they pause. That's what defines this moment. Not chaos, but hesitation. In suburban Arizona, open houses still draw crowds, but they're quieter. Agents talk about serious buyers only. Investors who once flipped homes in months now hold longer, waiting for signals. Builders, too, are hedging. They've started offering incentives, free upgrades, rate buy-downs, closing assistance. Not because demand has vanished, but because competition has intensified. It's what economists call a soft landing scenario. The plane hasn't crashed, it's just circling the runway, waiting for better visibility. Yet under that calm surface lies a buildup of energy. Imagine a dam holding back years of demographic demand. Millennials aging into peak buying years, families relocating from high-cost states, retirees seeking sunshine and stability. That demand hasn't disappeared. It's merely waiting for affordability to blink. And when it does, when mortgage rates finally dip below 6%, that dam could burst. If that happens in 2026, Arizona's housing market could see a mini surge. Transactions could rise 5 to 10% year over year. Prices might grow 3 to 7% in key corridors, especially around job-dense, transit-connected areas. But if rates stay sticky, hovering in the mid-sixes, the outcome changes. Growth becomes uneven. High-demand areas hold their ground. Weaker neighborhoods soften. Builders offer bigger incentives. Investors move cautiously. Price appreciation shrinks to 1 or 2% or disappears altogether. And then there's the third path, the dark one, where rates rise above 7% again. It's not the base case, but it's possible. Inflation could reemerge, or global uncertainty could push investors back towards safe U.S. bonds, driving yields up. If that happens, affordability takes another hit. Demand retreats, sellers face pressure, builders pull back. But even then, Arizona's market wouldn't collapse. Why? Because this isn't 2008. Lending standards are stronger, down payments are larger, and speculative buying is far smaller. What we'd see instead is segmentation. Parts of the market cooling sharply, others staying surprisingly resilient. In other words, the calm before the shift doesn't always lead to a crash. Sometimes it leads to transformation. That's what makes this chapter of Arizona's housing story so fascinating. It's not driven by fear, but by recalibration. Buyers, sellers, lenders, and builders are all adjusting their expectations, recalibrating what normal looks like in a post-pandemic economy. Inflation may be easing, but it hasn't vanished. Wages have grown, but not fast enough to offset higher borrowing costs. And while inventory is rising, it's still below long-term historical averages. So what does this mean for 2026? Economically, it means Arizona's housing market is entering what analysts call a conditional equilibrium. Every variable, rates, wages, inflation, migration, construction costs, has to hold its position just right for the balance to last. If anyone shifts, the others react instantly. That's why local expertise matters more than ever. In Arizona, no two zip codes behave alike. School districts, commute times, and neighborhood amenities create micro-markets within the broader state economy. A seller in Gilbert faces different dynamics than one in Tucson. A buyer in Scottsdale negotiates differently than one in Goodyear. This is where the story of Arizona mirrors America itself, a patchwork of local economies tied together by a single thread: confidence. When confidence wavers, markets hesitate. When it strengthens, momentum returns. As 2025 progresses, the big question isn't whether the market will boom or bust. It's whether it can maintain this fragile balance long enough to transition smoothly into the next phase. Because this calm, this quiet before the shift, is temporary. Maybe the next move will be gentle, a slow drift toward stability as rates ease and buyers return. Or maybe it'll be sharper, a reset that exposes overvalued pockets and rewards patience. Either way, Arizona's housing market is about to redefine its identity. Not as the runaway success of 2021, and not as the fearful correction some predict, but as something more mature. An economy learning how to grow in a world where certainty no longer exists. In the months ahead, watch three signals: mortgage rate trends, supply curves, and buyer sentiment. These aren't just data points, they're emotional indicators of economic confidence. When rates fall even slightly, buyers rush in. When listings rise too quickly, they retreat. And sentiment, that invisible heartbeat of the market, shifts with every headline. If you listen closely, you can almost hear it, the rhythm of hesitation turning into motion. For now, Arizona's real estate market stands still, suspended between risk and opportunity. But soon one side will blink. And when it does, this calm will end. Quietly, suddenly, and completely. Because every calm has a purpose. It's not the end of movement, it's the breath before momentum. And as 2025 draws to a close, Arizona is holding that breath. What happens next will shape not just its housing market, but the economic story of the American Southwest for years to come. Behind every mortgage rate chart flashing across the news, there's an invisible hand shaping what buyers can afford, what sellers can demand, and what the housing market becomes. Most people think that hand belongs to the Federal Reserve, but the truth is far more complicated. The Fed doesn't directly control mortgage rates. It influences them, yes, but not in the way most people believe. When Jerome Powell speaks, markets react not because he sets the number, but because he shapes expectations. The real power lies somewhere else, hidden within the bond market and the psychology of investors who move trillions of dollars every single day. This is the force driving the Arizona housing market as 2025 nears its close, and it's rewriting every rule buyers and sellers thought they understood. Let's step inside that system. When you apply for a mortgage, your lender doesn't hold your loan forever. It usually sells it to investors as a part of a mortgage-backed security, a financial bundle that pays steady income over time. Those securities trade on the open market just like stocks or bonds, and their prices rise or fall depending on what global investors believe about inflation, risk, and future interest rates. That's where the real game begins. When investors sense danger, maybe geopolitical tension, rising inflation, or a weak jobs report, they rush to safety, buying U.S. Treasury bonds. That demand pushes Treasury prices up and yields down. Since mortgage rates tend to move with those yields, rates can suddenly drop, even if the Fed does nothing. But when confidence returns, money flows out of those bonds and back into riskier assets like stocks. Treasury yields rise, and so do mortgage rates, sometimes overnight. It's a cycle driven not by policy, but by emotion. Fear lowers rates. Optimism raises them. The market breathes in and out, and Arizona's housing market follows its rhythm. Back in September of 2024, when the Federal Reserve cut its base rate, homeowners expected relief. Instead, mortgage rates jumped. It seemed irrational until you understood the psychology. Investors worried that the Fed's move was too soft, that inflation might linger longer than expected. They dumped bonds, pushing yields up. The result? Mortgage rates climbed, not fell. That moment exposed the truth. The Fed leads with words, but the market moves with confidence. As 2025 unfolded, volatility became the new normal. Rates dropped below the highs of the previous year, only to rise again by a fraction of a percentage point. It didn't sound like much, but for buyers, that small shift could mean losing or gaining tens of thousands over the life of a loan. This uncertainty is what economists in Arizona call the new instability premium. Every buyer pays it not through higher fees, but through unpredictability. To understand how this affects Arizona, we have to zoom out. The mortgage market is tied to the 10-year Treasury yield, the benchmark investors use to measure risk-free return. When that yield stays near 4%, mortgage rates tend to hover between 6 and 7%. But every fluctuation ripples outward, touching everything from home prices in Phoenix to construction timelines in Tucson. So what's really controlling the yield? Inflation expectations, credit risk, and investor emotion, three forces as old as money itself. First, inflation expectations. If investors believe prices will keep rising, they demand higher yields to compensate for the lost value of future payments. Higher yields mean higher mortgage rates. It's that simple. Second, credit risk. If investors fear defaults, even small ones, they demand extra return for holding mortgage-backed securities. Lenders pass that cost on to borrowers. And finally, emotion, the most unpredictable of all. Markets react instantly to headlines. A positive jobs report can lift optimism. A sudden oil price spike can send panic through bond traders. It's not math, it's mood. Right now, that mood is tense. Investors are split between hope and caution. Inflation has cooled from its peaks, but it hasn't vanished. The global economy feels steady, but not secure. That tension has created the tightrope Arizona's housing market is walking on. Buyers feel it every day. One week, rates drop slightly, and listings see a rush of showings. The next, a small market scare sends rates back up, and the same buyers step back, waiting for clarity. This start-stop rhythm defines 2025, and will likely define the opening months of 2026. The irony is that even as rates move unpredictably, the fundamentals of housing remain solid. Demand exists, it's just waiting for affordability to blink. In the second half of 2025, most analysts expect rates to settle somewhere in the mid-6% range. Not low enough to unleash a frenzy, but not high enough to cause a collapse. It's the middle ground of uncertainty, and that's what makes it so powerful. If rates drift down toward 5.5%, that's when the magic could happen. Pent-up demand could explode. First-time buyers, relocating families, even investors waiting on the sidelines could rush back. Transactions could jump by 5 to 10% year over year, especially in job-rich corridors like Phoenix's East Valley and the expanding tech hubs in Scottsdale. But if rates stay sticky, floating around 6.5, demand will remain cautious. Buyers will shop longer, negotiate harder, and avoid overpaying. Sellers will adjust, offering concessions, rate buydowns, and flexible closing dates just to keep deals alive. And if rates climb above 7% again, a less likely but possible outcome that could test the market's strength in ways not seen since the pandemic era. Affordability would tighten sharply. Builders might pause projects. Sellers would compete more fiercely, and price growth could stall. Yet even that scenario wouldn't mirror the crash of 2008. Lending standards today are stronger, speculative flipping is minimal, and household balance sheets are healthier. The system isn't collapsing, it's recalibrating. That's the word that defines this moment: recalibration. The old assumption that mortgage rates simply follow the Fed is fading. In its place, a more complex truth has emerged, one that ties housing directly to investor psychology. Arizona is feeling that more than most states because of its dynamic growth. People continue to move here. Retirees seeking sunshine, remote workers chasing space, companies expanding into business-friendly environments. That population inflow creates a cushion under demand. It doesn't eliminate volatility, but it prevents collapse. In other words, the hidden force behind mortgage mayhem isn't just economics. It's emotion layered over opportunity. Behind every buyer waiting for the right rate is an investor watching the same chart, guessing which direction yields will go next. When fear wins, money flows to bonds, rates fall, and buyers rush in. When optimism takes over, money leaves, rates rise, and the market pauses. It's a loop that keeps the housing market in motion, a pendulum that never stops. As we move toward 2026, the question isn't just where rates will go, but why they'll move. Will inflation calm enough for investors to relax? Will global risks drive them back toward U.S. bonds? Or will optimism about growth push yields higher again? Every answer to those questions writes the next chapter of Arizona's real estate story. Because when you strip away the headlines and hype, the housing market is a mirror, reflecting how much people trust the future. When trust grows, so does demand. When fear creeps in, it fades. And right now, Arizona stands between both, powered not by chaos, but by emotion disguised as economics. This is the hidden force behind mortgage mayhem, the quiet energy inside every percentage point, the unseen psychology inside every price tag, and the reason why predicting the housing market has never been harder or more fascinating. In the final months of 2025, Arizona's housing market is no longer moving as one single rhythm. What was once a unified wave of rising prices and fierce competition has now split into two distinct realities, one glittering with luxury and another quietly struggling under the weight of affordability and uncertainty. The difference between these two worlds has never been more visible. In the upscale neighborhoods of Scottsdale, Paradise Valley, and parts of North Phoenix, confidence hasn't vanished, it's merely evolved. Wealthier buyers, many of them moving from out of state or liquidating stock portfolios during market highs, are still active. To them, real estate is less about affordability and more about opportunity, lifestyle, and long-term preservation of value. These buyers are watching the same economic turbulence that freezes middle-income families, yet their decisions are driven by different motives. They're hedging against inflation, seeking tangible assets, and buying space, privacy, and prestige. But just a few miles away, in Arizona's entry-level markets, a very different scene unfolds. Families who once dreamed of owning their first home are now recalculating every dollar. Mortgage rate fluctuations have turned optimism into anxiety. Even a small rate increase, say from 6% to 6.5%, can add hundreds to a monthly payment. For a family already battling high grocery costs and rising insurance premiums, that difference is the line between possibility and postponement. The tension between these two groups, the hopeful sellers and the hesitant buyers, defines Q4. It's not simply about supply and demand, it's about psychology. Sellers in the mid and lower tiers are coming to terms with a new reality. The bidding wars are gone, the multiple offer weekends have faded, and the open houses that once drew crowds now attract silence. Many sellers still anchor their expectations to last year's headlines, convinced that price appreciation will somehow resume its upward march. But markets don't move on, hope they move on math, and the math is tightening. In the higher-end segments, however, the story bends differently. Inventory remains limited, not because of a lack of sellers, but because wealthy homeowners often have the luxury of time. They can wait out the market. They can pull a listing, renovate, or rent their property until the next wave of demand returns. And because the luxury segment is driven by discretionary buyers, it's less sensitive to mortgage rates. A cash buyer from California or Texas isn't asking what the 30-year fixed rate is this morning. They're asking whether the view is worth the price tag. That creates a striking imbalance. While the median market bends toward caution, luxury listings occasionally spark bidding again, almost in defiance of the broader trend. But beneath that surface, confidence lies something subtle. Even the affluent are more strategic now. They're negotiating harder, comparing comps meticulously, and waiting for small dips to strike. The psychology of abundance has given way to the psychology of precision. Economically, this divergence traces back to how wealth and liquidity interact with credit conditions. When interest rates rise, credit-dependent segments slow first. Entry-level buyers rely on financing, and their purchasing power is directly tied to rate shifts. For every half-point jump, affordability can drop by as much as 5 to 7%. But for cash-heavy buyers, those same rate changes are almost irrelevant. They may even welcome them, since fewer finance competitors mean less price pressure. This is why Q4 reveals not just who can buy, but how they buy. The lower tiers lean on pre-approvals, mortgage brokers, and incentives. The upper tiers lean on liquidity, timing, and leverage in entirely different forms like equity transfers, deferred taxes, or capital reallocations. Two worlds operating under the same sky, yet moving by different gravitational pulls. Now let's look closer at why this divide is widening right now. First, the bond market, the quiet engine behind mortgage rate movements, has remained volatile. When investors demand higher yields on 10-year treasuries, mortgage rates follow suit. Even though inflation data has improved slightly, investor skepticism about future stability keeps yields elevated. That directly limits affordability in mainstream housing. Second, household sentiment has weakened. Surveys show that a growing share of potential buyers now believe housing is overpriced, not just nationally, but locally. This belief alone, even without drastic financial change, can slow market momentum because perception becomes participation. If enough people believe prices might fall, they stop making offers, and that hesitation turns into real downward pressure. Third, cost of living adjustments have failed to keep pace with shelter inflation. Even as wage growth shows improvement in certain sectors, it lags behind cumulative housing costs over the last 4 years. For most working households, the math simply doesn't work. That imbalance is forcing first-time buyers to delay ownership and stay in rentals longer. And that ripple feeds directly into seller frustration. Meanwhile, builders face their own dilemma. Construction material costs have stabilized but remain elevated compared to pre-pandemic levels. Labor shortages persist, especially in trades like electrical and HVAC. Developers must weigh whether to launch new projects or wait for more predictable demand. As a result, new housing supply enters the market slowly, often too slowly to rebalance prices. For those selling in the luxury segment, this slowdown is more of a pause than a panic. Their buyers often come with cash or with portfolios diversified enough to absorb volatility. These are individuals treating homes as financial shelters during times of global uncertainty. When stock markets wobble or currencies lose ground, they turn to real estate for safety. That's why we're still seeing record transactions in elite enclaves. Not because everyone's thriving, but because capital seeks stability where emotion drives fear. On the other hand, sellers in the entry-level segment face tougher conversations with realtors. The question is no longer, how high can we list, but how low do we need to go? Many of them bought during the boom with historically cheap mortgages, 3 or 4%, and are reluctant to sell because they'd lose that golden rate. That creates a bottleneck. Supply loosens only when necessity outweighs reluctance. And in Q4, that necessity is often relocation, divorce, or financial strain, not ambition. Buyers sense this tension and use it as leverage. They're asking for closing cost credits, repair concessions, and rate buydowns. Sellers who refuse often see listings linger. This standoff is subtle but powerful. It's reshaping negotiation norms that had tilted heavily toward sellers for nearly half a decade. The pendulum is swinging back toward balance and maybe even a slight advantage for buyers, but only in selective pockets. It's important to remember that Arizona's housing story is not one uniform narrative. Phoenix, Mesa, and Tucson each move with distinct dynamics. In the Phoenix metro area, investor activity still plays a role. Institutional buyers occasionally re-enter when prices dip, especially in rental-strong neighborhoods. In contrast, Tucson's market feels more organic, with slower price swings but steady end-user demand. The state's diversity prevents a single label like crash or boom from applying everywhere. Looking deeper into the psychology of sellers, there's a clear emotional layer too. Many homeowners who bought during the pandemic felt they had captured once-in-a-lifetime appreciation. Now, as listings stagnate and price cuts become routine, disappointment settles in. That disappointment turns into denial, and denial delays price adjustments until reality forces recalibration. But when enough sellers finally lower prices simultaneously, the market can briefly overcorrect, producing short-lived windows of opportunity for buyers. In luxury markets, the emotion plays differently. There, selling a home is not about survival, but prestige. Price reductions are disguised as strategic repositioning or limited time adjustments. The language softens the optics, but the underlying truth remains. Even the wealthy are acknowledging that easy gains are gone. They're not panic selling, but quarter four therefore becomes a season of contrast restraint for some, repositioning for others. The winners are those who adapt fastest. The sellers who price with precision, the buyers who negotiate intelligently, and the agents who interpret local data instead of national noise. The losers are those who cling to old assumptions, that demand will always outpace supply, or that buyers will eventually cave in. The market is no longer rewarding stubbornness, it's rewarding strategy. By late December, we'll likely see clearer signs of segmentation. In luxury areas, subtle bidding could return as affluent buyers chase limited inventory. In mid-tier zones, stabilization will depend on how quickly mortgage rates settle. And in the entry-level markets, patience will remain the best currency. Buyers who wait for emotional sellers to cut prices may find themselves securing homes at fairer valuations, not because the market collapsed, but because confidence did. Ultimately, the Arizona housing landscape in quarter four is less about chaos and more about calibration. The frenzy of past years has given way to analysis, reflection, and strategy. It's an environment that tests not just financial resilience, but emotional intelligence. The era of impulse buying is ending, and the era of informed decision-making is taking its place. And perhaps that's the hidden victory in all this. While some call it a downturn, others will see it as correction, a long overdue reset that rewards patience, preparation, and perspective. Those who can read the signals, control their impulses, and act with timing rather than panic will walk away stronger. The Arizona housing market isn't dying, it's maturing. And in that maturity lies both caution and quiet opportunity. As Arizona edges toward the year 2026, the housing market stands at a crossroads. The air feels different, quieter, tense, like the pause before a storm or maybe a long-awaited calm. After years of turbulence, from the pandemic surge to the interest rate roller coaster, everything now hangs on one question. Where do mortgage rates go from here? Economists call this moment the Great Split because the road ahead could divide sharply in three directions. Each path carries its own story, one of revival, one of uneasy balance, and one of renewed struggle. Let's start with the most hopeful. If mortgage rates fall below 6%, a level that once felt impossible just a few years ago, Arizona could awaken from its long housing fatigue. Pent-up demand, locked behind high borrowing costs and fading affordability, might burst open like a dam finally giving way. Young families who've been renting for years could return to the market. Retirees from colder states might once again see Phoenix and Scottsdale as affordable escapes. Under that scenario, home sales could climb steadily. Construction crews, quiet for too long, would fill the suburbs again. Developers would push new projects, and price appreciation after nearly flat years could regain a healthy 3 to 7% in many neighborhoods. But this growth wouldn't feel like the frenzy of 2021. It would be slower, more deliberate. shaped by lessons learned from the boom and bust cycles that scarred Arizona's past. Still, lower rates would mean renewed confidence. Homeowners might finally list their properties, breaking the inventory freeze that's kept supply tight. Builders could breathe easier, knowing buyers are back. And perhaps, just perhaps, this would be the spark that rebalances Arizona's housing dream. But that's only one version of the story. The second path, the middle road, might be the most realistic. Suppose mortgage rates hover around the mid 6% range, not high enough to crush demand, but not low enough to spark a true rebound either. That's the balancing act economists believe is most likely. In this world, the market remains uneven, a patchwork quilt of gains and losses, depending on zip code, price range, and condition. Some areas, especially newer developments with strong schools or walkable amenities, could hold steady or even inch upward. But older neighborhoods or homes needing heavy renovation might soften further as buyers get pickier. Sellers will have to adjust expectations. Gone are the days of instant bidding wars and sight unseen offers. Now presentation and pricing precision matter more than ever. A well-staged home could move in weeks. A careless listing might sit for months. Buyers, meanwhile, regain some control. They can negotiate, they can wait. Construction companies may find themselves walking a tightrope. They'll still build, but cautiously. Incentives from rate buy-downs to free upgrades will become the new normal. Investors, too, will grow selective, focusing on quality locations and long-term stability rather than fast flips. This middle road isn't glamorous, but it's healthy. It's the kind of slow, steady market that builds sustainability, something Arizona has needed for a long time. Then there's the third possibility, the one few want to imagine, but many quietly fear. What if mortgage rates climb again, pushing above 7%? It's not impossible. Inflation could flare up. Global uncertainty could drive investors toward safer assets, tightening credit conditions, and suddenly that fragile stability could shatter. Demand would retreat. Buyers already stretched thin would step back. Sellers would feel the squeeze. The signs would show quickly. Days on market would lengthen. Price cuts would become routine. Builders might pause projects mid-plan. And investors, especially short-term flippers or highly leveraged landlords, could find themselves in dangerous territory. Yet even here, not everything would be bleak. Markets like Arizona have shown resilience before. During downturns, the state often resets faster than coastal regions. Lower land costs, population inflows, and strong job creation in tech and logistics still make it one of America's most adaptive economies. In this harsher scenario, opportunity would shift away from quick profits and toward patient investing. Cash buyers, institutional players, and families with long horizons could benefit the most, picking up assets at discounted prices while others retreat. Whichever road we take, the truth is this: 2026 will not be a repeat of 2021's madness or 2023's exhaustion. It will be a year of reckoning, a mirror that reflects how Arizona learned from its past. One core truth will guide everything, local nuance will dominate. There is no single Arizona market. There are micro markets: Chandler, Tempe, Mesa, Tucson, Flagstaff, each with its own rhythm, its own heartbeat. A good school district or a 5-minute shorter commute could swing prices by tens of thousands. The difference between a modern kitchen and a dated one could decide whether a listing gets traction or gathers dust. By late 2026, headlines will probably sound contradictory. One report might say Phoenix housing rebounds. Another might scream Tucson market stalls. Both could be right. That's why the smartest players, homeowners, agents, and investors, will be the ones who read beneath the headlines. They'll study not just mortgage rates, but the deeper forces driving them: bond yields, global capital flows, and inflation expectations. They'll watch the labor market, construction permits, and demographic shifts. They'll see the story unfolding before others do. The key to surviving and thriving in 2026 will be adaptability. Sellers who stage strategically and price realistically. Buyers who lock rates wisely and shop patiently. Builders who balance risk with opportunity. Because when a market splits, it doesn't vanish. It evolves. And in that evolution lies the next chapter of Arizona's housing story, one defined not by panic or hype, but by precision, patience, and a new kind of confidence. The year 2026 won't be about crashes or bubbles. It'll be about decisions small, informed, strategic ones that quietly shape the next decade of Arizona's real estate future. As Arizona approaches the end of 2025, the housing market feels suspended between hesitation and opportunity. Every buyer, seller, and investor is asking the same question: what should I do before the new year arrives? The answer depends not on timing the market, but on understanding its direction and acting with discipline before the window narrows. Let's begin with what matters most: clarity about conditions. Mortgage rates remain the single largest force shaping the next phase. They're hovering in the mid 6% range, lower than they've been for most of the past year, but still volatile. That uncertainty is what defines this moment. If you're a buyer, that volatility isn't your enemy, it's your opportunity. Rates can swing fast, but history shows they rarely stay still for long. When the next downward move comes, even a small one, the best prepared buyers will capture it. That means having your financing, documentation, and pre-approval ready before the headlines announce a rate drop. Because once that happens, competition will return overnight. You won't have time to prepare later. You'll either already be ready or you'll miss it. For sellers, this final quarter before 2026 is your moment to act with precision. If you're holding property that's been sitting unsold, don't assume that waiting for the spring will bring higher prices. In most Arizona submarkets, inventory is rising quietly but steadily. That means buyers are gaining leverage, and they're more selective. The homes that move fastest now are those that tell a clear story: well-priced, well-presented, and positioned for immediate move-in. Think of it this way: the market no longer rewards potential, it rewards readiness. A home that looks polished and priced right will sell even in a cautious market. One that feels uncertain, needing updates, repairs, or justification will struggle. Presentation isn't cosmetic, it's strategic. Another crucial point: timing matters more than optimism. Listing early in the quarter, October through mid-November, still carries an advantage. Many buyers want to close before year-end for tax, relocation, or personal reasons. But as December approaches, buyer urgency fades and discount expectations rise. If you plan to sell, moving sooner rather than later may protect your price. Now for the buyer's playbook. The smart move before 2026 is not to rush, but to prepare deeply. Track local data, not national headlines. Pay attention to days on market in your target neighborhoods. When that number stops climbing, it's a signal. The balance of power is shifting. That's your cue to act before prices adjust upward again. Locking your mortgage rate strategically will be one of the most decisive financial choices you make. If rates dip below 6%, competition will intensify fast. Consider locking early with a float-down option, or partner with a lender who allows relock flexibility. The difference between acting early and waiting a few weeks could cost tens of thousands over the life of a loan. For investors, this is not the year for speculation, it's the year for precision. Focus on properties with strong rental potential, solid infrastructure, and long-term demand drivers, near universities, job corridors, or expanding tech zones. Skip the quick flips and look for value you can hold. The real wealth in the next cycle will come from stability, not speed. And for both buyers and sellers, one principle outweighs all others. Watch the data, not the noise. Economic headlines can sound dramatic, but the real story always plays out locally. A half-point change in rates might dominate national news, but a 5-minute commute improvement or a new school district line can shift neighborhood prices far more. Real estate is local first, macro second. If you're selling, understand your submarket better than anyone. Study recent closings, know your competition, align your pricing with what's moving, not what's lingering. If you're buying, evaluate the property, not the panic. Quality, efficiency, and long-term livability will define future appreciation, not short-term hype. Finally, remember this truth: markets don't reward fear, they reward preparation. The smartest decisions before the new year aren't made in reaction to the news. They're made quietly, with analysis, timing, and patience. The people who win in 2026 will be the ones who treated this transition as an opportunity to plan, not panic. So as you step into the last quarter of the year, think less about predicting the market and more about positioning yourself for whichever direction it takes. Because whether rates rise, fall, or hover, there will always be someone on the winning side of the decision. The question is simple. Will it be you?